Welcome everyone. Happy Tuesday. I hope you all had a great MLK holiday weekend. Thank you for joining today's webinar, where we'll be talking about optimizing your self-directed IRA through multifamily investing. It is top of the hour, and of course I want to be respectful of everyone's time, so let's go ahead and get started. I'm Reneika Lightbourne with Advanta IRA, and I'm delighted to be joined by multifamily experts Fleming and Kim Bruggeman from Greenstone Multifamily. So thank you both for being our featured speaker today.
Yeah, thanks, Reneika.
Hi, thank you for having us today.
Oh, you're certainly welcome. So Kim and Isaac is going to cover some of their strategic advantage as a national multifamily real estate investment company and also the asset management portion of their business. But before I turn it over, I do want to give you a synopsis of self-direction as a whole. Some of the steps to get started or the steps to get started with us, and of course, the ins and outs of self-direction. If you have questions, just feel free to type those in the question box. We will allocate some time at the very end to get those answered for you. So let me just go ahead and, again, I'm Reneika Lightbourne. I'm one of the business development specialists here at Advanta since 2019. I'm also an active self-directed IRA investor as a client of Advanta prior to joining staff. For you, if you have specific questions or you want to do a one-on-one or just talk through your scenario, you're welcome to give me a call, send me an email, or schedule a consultation by visiting advantaira.com. So just a quick disclaimer before we get started. Just know at Advanta, we don't give any tax, legal, or investment advice. All of the information that we're going to present today is just for educational purposes. So we always encourage you to please do your own due diligence. Make sure to consult with your professional team, whether it's your attorney or your accountant or financial advisor, before making any investments. So quick takeaways from today's presentation. Just know that any IRA or former employer plan like an old 401k qualifies to be self-directed. You choose the investment that works best for you. In this case, we're going to be focusing specifically on multifamily investing. And then, of course, any income that's generated from your investment flows back into your retirement account. If you have any if there's any applicable expenses, it's paid out of the retirement account. So just a little background about Advanta and who we are. We are one of the nation's leading self-directed IRA administrator. We've been in the business for about 20 years as one of the leading providers for self-directed IRA accounts. We have well over $2 billion under administration. Our headquarters is in Largo, Florida, which is Tampa Bay area. Advanta has an office here in Atlanta, which is where I'm based, but we do work with clients nationwide. If you have cash sitting in your account with us, do know that it's FDIC insured. But for you as a client, once you do make the investment, again, you want to do your due diligence. You have to take on the responsibility that once you make that investment, you're comfortable with any risk associated with that. In terms of how we differentiate ourselves from our competitors, our focus is providing you that customer, that customer service, that high concierge style service to where you have a dedicated account manager, you have a direct point of contact that's going to be with you for the life of your account with us. And of course, our educational tool where we provide you guest speakers and experts like Kim and Isaac today. In addition to doing weekly webinars, we also do a networking event. We have what's called Pitch, Promote, Prosper. We do that every other Friday. So again, you can check out our website to register to attend. In addition, we also have a blog that features all of the latest industry news, and my colleague Alex Kearney does our podcast. This webinar is recorded. It will be on our YouTube channel within 24 to 48 hours, but you can also access it on advantaira.com on our on-demand channel. So exactly what is a self-directed IRA? Self-directed IRA just means that you as the account owner, you're going to have complete control over your retirement funds. You get to decide what is it that you want to invest in, but also too, you get to diversify outside of the traditional stocks and bonds. You can use IRA funds to invest in real estate like we're going to be focusing on today. You can also use IRA funds to invest in notes and mortgages, tax liens, oil and gas, precious metals. The list goes on in terms of what's on the table for you. So why do people choose to self-direct? You can look to self-direct for many different reasons. I'll just touch on 3 of them. One, it's a new source of capital for you. So if you have funds that's sitting in an old retirement account, whether it's an IRA or an old 401k, you can elect to put it to work. Or if you're an investment provider and you're looking to raise additional capital for your investments, this is a good way to approach some of your existing clientele or make other clients out there whether they can use retirement funds to invest with you. And then, of course, another reason as to why someone may self-direct is because of the ups and downs in the stock market, the volatility. A lot of times when I'm talking to clients, obviously they have concerns about, losing a certain percentage of their retirement funds that's in the stock market. Whereas with self-direction, you're investing in the likes of real estate where we know it's going to retain value. It gives you the ability to diversify. And then, of course, the tax benefits, having those rents, those profits, those dividends flow back into your retirement account, tax-free or tax-deferred, depending on the type of account that you have. In terms of the different types of accounts that can be self-directed, for individuals, you can self-direct a traditional or Roth IRA. For traditional, it's tax-deferred, meaning you get the tax deductions up front. And then, of course, at retirement, that's when you like to pay taxes at that time. Whereas with a Roth IRA, you decided you're going to pay taxes up front, grow that account over time. Once you reach retirement, you take those funds out. It's tax-free. If you are a small business, an entrepreneur, or business owner, you can elect to self-direct a SEP, simple or solo 401k. There's some changes with the Secure 2.0. My colleague Alex actually just did a webinar on that, so feel free to refer back to that in terms of some of the new benefits or additions to these self-directing accounts. Some other or lesser known accounts that can also be self-directed are educational savings account and HSAs. HSAs, you have to have a high deductible medical coverage to be able to self-direct or have an HSA. But you can certainly, if you're eligible, certainly self-direct that to cover those medical expenses. And then, of course, any former employer plan, whether it's an old 401k or 403b or TSP type plan or pension plan, can be self-directed. Again, the key difference is the contribution limits, and we'll talk about that on the next slide. And then, of course, with a Roth account, as long as you've had that account for 5 years and your retirement age of 59 and a half, you can take those funds out of the Roth account tax-free. For 2023, we did see an increase in annual contributions. So for traditional Roth IRA, you can put in $6,500 if you're under the age of 50, or $7,500 if you're over the age of 50. For SEP IRA, 25% of your earned income. So in this case, up to $66,000. For the simple IRA, it's $5,500, and with your employer match of up to 3%. Again, if you're over the age of 50, you can put in an additional $3,500. For the solo 401k or individual K, you can contribute $22,500. If you're over the age of 50, you have an additional increase where you can put in $7,500, and then the employer match would be up to 25%. ESA, the actual contribution stayed the same, $2,000 per year per child. And again, that can cover, anything related to educational expenses up until all through high school, from kindergarten all through high school. And then, of course, with an HSA, we did see an increase for individuals. You can contribute $3,850, and for family plan, you can contribute $7,750 with an additional $1,000 catch-up if you're over the age of 55 for an HSA. So the process with us to get started is pretty straightforward when you're ready. Step one would first and foremost would be completing the application. You can do it electronically via DocuSign, or we can actually, walk you and guide you through that. We'll get your account set up within 24 to 48 hours. Again, you'll be assigned a dedicated account manager. Step two is funding the account. You can do a combination of making a cash contribution. You can transfer funds from an existing IRA, or you can do a direct rollover from one of those previous employer plans. And then finally, step three is make your investment. Are you going to be passively investing in a multifamily unit, or investing in something else? And with that, I'll go ahead and turn it over to our guest speaker. So Isaac, let me go ahead and make you the guest speaker. Just bear with me one moment.
Okay.
Okay, I can see your screen. Thank you.
Okay, good deal. All right, I'm gonna let Kim Bruggeman introduce us. She is the owner and partner of Greenstone Multifamily, ton of experience, a wealth of knowledge. So I'm gonna let Kim get us started, kind of talk about her, what we do broadly, and then I'll take it over and get into some underwriting and some capital structure stuff. So Kim, whenever you're ready.
Thank you, Isaac. And again, Reneika, thank you so much for having us today to talk about Greenstone and our passion and our purpose. So we're super excited to be here today to share with each one of you. So as everyone mentioned, my name is Kim Bruggeman. I am one of the managing partners of Greenstone Multifamily. We are a real estate investment company specializing in acquiring value-add multifamily assets in high-growth submarkets. We have invested in assets all throughout the United States, and our recent primary focus is within the Southeast. So we are a vertically integrated company, which means we do everything in-house from pre-acquisition, that's operations, asset management, construction management, through disposition. And I'll go into that in just a little bit deeper, what vertical integration means in just a second. Greenstone and our partners, we've been operating, investing, and purchasing assets for over 15 years. And I think that we bring a very unique skill set to the industry through our diversity and our unique skill corporate team. My partner, Eddie Kozak, he has an extensive background in engineering and construction management, as well as in truly understanding very unique investment and value add opportunities. He plays a big part in our acquisitions, looking at opportunities and helping to create the investment model and the construction model. And so just a little bit about myself. I began my real estate career over 18 years ago in the hospitality management industry. Had a lot of large clients that I built trusted relationships with, such as Fannie Mae, Freddie Mac, a lot of large lenders, special servicers, and private investors, each of them having multifamily in their portfolio, and wanted us to assist with these assets. So after much research and development, I started the multifamily division within that company. And during that time, I also became a court-appointed receiver to assist my clients with their underperforming assets by stabilizing them, repositioning, managing, or sometimes, unfortunately, helping them to dispose of those assets. That really just sparked a desire in me to really focus my my career on multifamily. At that time, I partnered with Eddie, and we formed our company, and we've spent the majority of our career fixing other people's problems. You know, going back to the beginning of these investment models, creating success plans for lenders and general partner groups and investors. And that period of time just really gave us a clear vision for wanting to help others do it right from the beginning. And so we set out on a journey to use our passion, which is our experience, for purpose, to help others, to create profit, which is, in our opinion, generational wealth, as well as in the wealth of the relationships that we build with others and the communities that we invest in. So I feel with Greenstone, we have very intentionally created a strong core team to accomplish our vision, which is investing in, owning, and operating assets. And we are just super excited to be able to make, I guess, a dent in the industry of doing something. There's a lot of companies that do what we do, but I feel like we bring a very unique perspective. And, you know, Isaac kind of switched through the slide there, but part of our, you know, that vertical integration is, I think, what makes our team significantly unique. There's a lot of groups out there that, you know, invest in assets and purchase assets, but truly having that vertical integration, which is being able to be a part of the cycle of the investment from that pre-acquisition side of really understanding what markets we want to invest in and why, building unique relationships within those markets, as well as all of our relationships with our investors, truly understanding what their investment needs are and their goals are, and aligning those with those investment opportunities. And I think that we've combined our industry operational experience with our own investment experience, and that's truly through, you know, we have purchased assets and disposed of assets, seeing them through multiple market cycles. That's in 08 and 09. We have managed and purchased and disposed of assets through COVID, as well as through inflation and interest rate changes. So truly having a group that can, see those diverse market cycles and be able to pivot when necessary, I think is huge. And I think that, Greenstone, we provide that unique ability to do so, and really forensically looking at all areas from, the investment, that's acquisitions, as Isaac is about to talk about, and how we uniquely underwrite and purchase our assets, to our operational team. That's sometimes we third party out that property management, and sometimes we do that in-house. As I've mentioned, we have property managed for over 19 years. So I think also doing the construction management, Isaac will talk a little bit more about that as well in detail. And then also, I think another great part that I really pride ourselves in at Greenstone is our investor experience. Something that we're very intentional about is really communicating and being transparent to our investors. And that is something that, I've seen, unfortunately, all too often, is investors not understanding where their money is going, how their money is working, and, being in communication with their general partner team is huge. So, Isaac, I'm going to turn it over to you to kind of go over a little bit more in detail about our investment structure, and then I'll talk a little bit more about asset management towards the end, and talk to you soon.
Perfect. Hi, everybody. My name is Isaac Fleming. I started in real estate when I was 20. I originally went to school for nuclear engineering. I love the intricacies and the details of it, but the whole market wasn't for me. And I discovered multifamily real estate and just fell in love with it. So I've been doing multifamily since then, variety of roles, but I really found my light in acquisitions and underwriting and the numbers behind what makes a property work. So that's just a little bit about me. But why multifamily? There's, as Reneika noted, there's lots of different classes you can invest in. But what makes multifamily special? So it's a $3 trillion industry. It accounts for almost 14% of the GDP, which is more than the entire tech industry combined. So it's nothing new, nothing small. It's a pretty big industry. There's just over 21 million apartment homes in the US and homes to over 36 million residents. Homeownership is getting more expensive. It's outpacing rental rates. Now, in the past couple of years, we've been on a crazy market and rental rates have started to catch up, but homeownership didn't really slow down. And with that, there's a demand, 4.3 million apartments by 2035. A nonprofit called weareapartments.org, they did a study and they said that we need 4.3 million apartments by 2035 to keep up with our population growth. So that's a huge amount of growth. And 46% of those were built before 1980. So there's just a huge lag in apartments, which is what's driving the demand for what we like to invest in. A big part of that is the millennials. So homeownership isn't quite what it used to be. It's much more popular now for younger people to put off buying homes until they're well into their 30s. They would rather be mobile, be able to get up and move when they want, where they want, and apartments allow that. Something cool about apartments that's different from a lot of other appreciating asset classes is we have direct control over the NOI, which is the valuation through forced appreciation. We can do things to alter that NOI to make that property more valuable. Again, with real estate, people think I'll buy a house. That's a good investment, and oftentimes it is. But with apartments, we get those advantages of buying a house, but in economies of scale. So, we have one roof and 40 units underneath it. We get to save all that money with economies of scale. It's a tangible asset. You can, set up a meeting with us. We can take you to the property. We can show you where your money's going. We can show you the asset, have you meet the people working on it. It's totally tangible. I mean, there's lots of stocks are great. All this NFT, crypto, digital, people make money and all that. At the end of the day, this is down the road. You can see it, you can touch it, you can feel it. It's there. There's no hidden fees for what we do. A lot of stock transactions, or call it what you want, there's transaction fees, all these little fees on top of it. We're pretty transparent, like Kim said, about what we do. We have certain capabilities for tax savings through cost seg studies, depreciation, that sort of thing. And one of the huge benefits of investing in real estate multifamily as a passive investor is you get the benefits of the ownership without the hassle of management. So you get to invest in an apartment complex and reap the rewards of that without dealing with the maintenance calls at 2 a.m., the busted toilets, whatever it may be. You just get the advantages of that, and we take on that arm of it. And it's less vulnerable to external factors. For example, Tesla. So, Tesla is one of the highest valued American companies right now, hugely popular stock, but it is vulnerable to some external factors. Elon Musk can go on Twitter, tweet something, stock prices tank. So let's take a second and talk about stocks. So the S&P 500, hugely popular, very, very solid place to put your money, right? So what I did here, I took the actual S&P 500 return for the past 20 years. Let's say you invested $100,000 in 2002. You make money, and then the stock market crash happens, 08, 09, it goes down. But ultimately, 20 years later, if you don't touch that money, you profit $506,000. It's pretty good. It's an average of about 0.82% per month. So not a bad place to put your money. But again, there's up and downs. It's a little all over the place, but you're still making money. This next slide is what people think the stock market is, right? You think you put it in, it's a nice, even rising graph. That's the average of all those real returns monthly for the past 20 years. That gives you a theoretical profit of about $100,000 more. So in a perfect world in the stock market, you would profit $614,000 instead of $505,000. And then I'm going to oppose that to what we do, which is 4 full cycle deals. So a typical deal for us takes 3 to 5 years. I put it 5 years in the long end. But again, this is the same model where you invest $100,000 to start out with, and then there's 4 full deal cycles in that. So you invest your $100,000 based on our latest closed deal return rates. At the end of those 5 years, we return 180. You reinvest in deal number 2, you return 324, reinvest deal number 3, so on and so on. And you end up with a $949,000 profit. Now, what that equates to is about a 16% return on your money. We pay six of it as a pref, and then we pay 10 of it as a pref on the back end. So again, this deal is closed. This is just based on a past deal we did, but it kind of shows the difference in these 3 assets. So again, you invest $100,000 start out with in each of those models, and then actually in the early 2000s, the stock market beats us. It just barely edges us out, and then the stock market takes a hit in 08 and 09, doesn't really recover, and real estate is doing well after that. So how do we do that? This sounds like some crazy numbers, but how is that possible? We do that through forced appreciation. So a common mistake I've seen lately is, in the buying climate we've been in, it's been a little bit too easy to buy multifamily. It's been kind of a buying frenzy. Everyone has just bought up all they can. And unfortunately, a lot of operators bank on markets appreciating because they have. Markets have appreciated, cap rates have been compressed for the past couple of years. So you could buy an asset, you could not increase the NOI, and you could sell it 18 months, 2 years later, and you would make money. But that's not a realistic cycle. The market goes up and down, rates go up and down, cap rates go up and down. We just happen to be in a really good spot for the past couple of years. So forced appreciation is what we do with value add. We add value to the property through increasing the NOI and cutting expenses. So for example, we have this property with an NOI of $750,000. It's a 6 cap property, it's worth $12.5. Now, in a good cycle like we've been in, that 6 cap might equate to a 5 cap 2 years later, and you would make money. But if you don't increase the NOI, if you go to sell, it's still worth $12.5, and you lose money because you have operational costs owning that property. What we do is force appreciation through value add and cutting our expenses. We increase the NOI, and at that same stable cap rate, that property is now worth $20 million. So that's how we do that. A good quick example of this is we buy a property for $2.5 million. It's 20 units. It's a 6 cap. It has $150,000 NOI, and rent is $12.50 a unit. Now we'll take that $2.5 million property, we'll just bump rents to $1,500. So that's just about a 20% rent increase. And we'll take our expense ratio from 50 down to 40%. So we have 60% income ratio. That brings our NOI to $216,000. At the exact same cap rate, that property has increased in value 44% to $3.6 million. So that's just a very, very basic example. As I'll get into in a second, it's quite a bit more complex than that, but that's a pretty quick way to show how we create value in multifamily by doing marginal rent increases and cutting marginal expenses. So now I'll get into my underwriting. This is my favorite part of this presentation, is the underwriting. I developed this calculator along with Kim and Eddie over the past about year and a half. And as far as I'm concerned, I've put up against most multifamily calculators in the market, and I haven't found one better. So like most people in our business, we start out with using calculators that we've kind of built or found or bought, and we couldn't get to do everything we wanted to do. So we started clean slate. We said, what are the things we want this to do for our investment model, and how do we want to do it? And we built this totally from scratch. This is 100% proprietary to Greenstone Multifamily. So what our calculator does, it uses an 84-month model to taper income and expenses to create a realistic financial model that informs our pro forma. That's a lot of jargon, but basically what that means is it tapers the expenses slowly. We don't increase those rents 20% of month one of year two. It moves very, very slowly and evenly each month to create the most realistic expense and income possible. And then that's what this is here. With inflation, we increase expenses, and it's slowly growing in that second picture, or it's slowly going down. We use a variable debt calculation. So, lately there's been a lot of variable debt being offered. We have that ability. We separate insurance from our inflation because insurance prices we found have rose quicker than our normal inflation. So we have the ability to make insurance grow differently, expense-wise compared to other expenses. We use a T3 income and T12 expenses. That ensures that we capture the latest income projections along with the T12 seasonal expenses. So, your utilities will look different in summer than they do in the winter. You may have more contract labor in different seasons. So we still want to include the whole T12, but we use a T3 income. And then we use a rent roll based day one income. So often when these properties are getting ready for sale, they get them really healthy. And over the past year, there may be two different properties you're looking at. There may be a property that's decent and maybe a property that's good by the time it's ready for sale. So what we do is get the latest rent roll and create an income model based off of the people that are actually in the units at the time we're underwriting, which creates the most realistic income picture we do. We separate transactional and equity costs. I'm not going to get into that right now because we're going to talk about it here in just a second. We use variable yearly inflation. So if we feel like the inflation's been crazy like it has been lately, we can create different figures for the next 2 or 3 years and make that different than let's say year 4 and 5. We use a rent roll based price increase model. So basically, I was talking about we use that rent roll based day one. Well, we also use that to see the average of those current collected rents, the highest of those collected rents, and then what we can get to market wise. And then we use that to split up those increases into realistic time periods. A common mistake of a lot of underwriting software is we're going to hit those rents year 2. All of those increases are going to be year 2, where that's not the most realistic. With a staggered lease cycle, it takes some time. It might take 18 months or 2 years to truly touch every single one of those units. So we use we have the ability to vary where we want to put those increases. After that, we have a per unit per month RUBS calculator. So residential utility bill back service. Basically, we're charging back for utilities. But a mistake I see a lot of people do in underwriting is they'll say, we want to charge 80% RUBS. Well, that may put you above what you determine your market rent is. So we show per unit per month what that price looks like to make sure that we're not going above market rent. We use a millage-based tax calculator. So taxes are not only different per county, but they're also different per municipality. So we have to calculate taxes very specifically for each market we go into. There's no one formula to do it, but we have a calculator that allows us to put the information we know into there to get the answer we want. We compare the seller's day one operational expenses to ours. So we can see where they're possibly spending more money. Ultimately, we know what our expenses are going to be because, like Kim said, we've had a lot of experience in the space for a while, so we know what we're going to spend on some expenses. But if something stands out, we can investigate it further and figure out why those expenses may be higher, and then adjust our model based on that. We have a unit-based and subject-based CapEx calculator. So I'll get into construction here in a second, but basically it's a good way for us to roughly but accurately calculate what we're going to spend CapEx wise. That's a major problem with a lot of multifamily underwriting that I see, is people don't put enough in for CapEx, and they'll say, well, we'll do 10 grand a unit. That sounds like plenty, but then you start going through the itemized things you're going to put in that unit, and you find out you may spend 12 to 15 grand on just the interiors, and then you still have your exterior renovations, your landscaping, pools, whatever it is. So we have an itemized CapEx calculator that helps us quickly and accurately determine what we're going to spend on that property before we do our full CapEx plan. And then finally, we have 3 to 7 year exit models. So if we want to exit year 3, 4, 5, 6, and 7, we have those options in the calculator as well. So really quick, I'm gonna hand it over to Kim to talk about due diligence, because that normally comes after underwriting, and then I'll go back to construction management after that. So Kim, take it away with due diligence.
Thanks, Isaac. So Isaac, you did a great job at explaining, what at Greenstone, that one of the other things we pride ourselves in is really forensically looking at those numbers. And part of what our the diversity in our group has brought to our team is being able to see a lot of other people's successes and failures. And as Isaac mentioned, the underwriting, there's a lot of different educators out there and different groups that have these underwriting templates that are basically, a fast model of seeing if the investment structure will work, but it doesn't really tie into the operational model. And so I think that is one of the things that I really wanted to point out as well, that we really spent a lot of time in being able to look at where the investment model can be supported through the operations, and then also give our investors the returns that they were promised and that the investment has matured to deliver. So alongside successful underwriting, what we do at that point is, once we've decided to purchase a deal or purchase an asset, we go into due diligence. And I think one of the other things that we find ourselves to be skilled at is looking at due diligence from a lot of different perspectives. That's in the financial review, looking at the lease audits, looking at the rent rolls, seeing how long residents have lived on the property, do they qualify to live there? When we project a rent growth, a value add increase on the property through income growth, can those residents sustain that growth? And are we going to come in there and put a very organic growth in there, or are we going to try to come in there and put a $500 rent growth onto somebody that barely meets the rental criteria currently? So we're going to see a large exit. And I've seen too many operators that don't plan for that. And so, are we budgeting cash flow shortage during those times to exit the unqualified residents to get higher quality, increased ability for people to be able to pay increased rents as well? So we conduct employee interviews, and we also look at, while we're doing that, are we going to retain the staff? We're listening to, what are the strengths and weaknesses of the asset, of the market that we're investing in. We're also, our construction management team is looking both interior and exterior of the asset. We're looking for risk and liability issues, as well as product improvement, what we're going to add as value to the asset, and really marrying all of those together. We meet with the on-site team, we meet with the market people there. So we're meeting with code enforcement, we're looking at economics. We're looking at, all different areas of the communities that we're investing in and pointing out the strengths and weaknesses and really collaborating together to come up with a real strong audit and due diligence that we're going to marry to Isaac's underwriting, and really looking to see that, can we create the story to support the numbers? And, a lot of people will use a third-party group to do their due diligence and not really understanding, the true financial side of it, as well as, the operations and the physical side of the asset. So I think that is something that is very integral in being able to support those numbers and create effective pro forma and your business plan and your CapEx plan as well, to be able to support the investment model.
Awesome. Thank you, Kim. All right, so what makes our construction services special? So normally when an operator buys a property, they will hire third-party construction to implement their CapEx plan they came up with. And that construction company has to do the CapEx plan that they are delivered. Well, what makes our construction management special is we are, it's in-house, it's in our office. So what we can do is we can work with them from underwriting to purchasing the property, and they can help guide that construction plan, either adjusting costs, adding things, taking away things, helping us get the more realistic model to deliver to them to perform on. But when it comes time to perform on, we have an advantage because essentially we have a cost plus model. We have around 25% discounts compared to other people because we're working for ourselves. We're not having to pay another third party to support their business. We're supporting our own business. So we buy 100% of the product. We have buying alliances and agreements all over the Southeast and across the country that helps us get specialized pricing. We ship it to our warehouse here in Georgia, and then we disperse that material out to the property. So it makes bulk pricing a lot more attractive and a lot more achievable, and it helps us do more on the property with the money we have. We use our own in-house design services for all of our projects. That's another way we can save money. We have the latest technology to separate ourselves with reporting, accounting, and scheduling services. We have in-depth due diligence experience. So it's really, really helpful when, Kim and and Eddie are going to look at a property. Kim can look at the financials, Eddie can look at the structural stuff, and it's really, really awesome when we're all doing our own separate things on the property. And then ultimately, we with that cost plus, we're saving money. I mean, that's a big differentiator. We're already getting the bulk discounts, we're already getting specialized pricing, but since we're working for ourselves, we don't upcharge. So that allows us to, whereas $1 million on one property may only go so far, because a part of that $1 million is for the construction fees, we get to spend that $1 million on the property for more actual material and more actual differences in the property, which allows us to do more to the property with the same amount of money. And I'm going to glance over these pictures so I can talk about some of our structure a little bit. But this was a property we had in Texas. We just made it nicer. This is what it looked like when we bought it. We added these AC enclosures, paint, landscaping, lights. It's just a nicer, cleaner, prettier property to come home to. Again, dated bathrooms, made them nicer, nice bright white, good lights, good appliances. This was an old tired property. It just needed some love. So we put some color in there. Again, we hid those ugly ACs, put a little landscaping. This is very, very common for the age of properties we invest in, just old, crappy parking lots. It's very, very simple and cheap to respray, restripe. It just looks nice. Again, this is an old unit. It's not bad per se, but we wanted to make it more modern and nicer and more welcoming. So we put wide plank LVP, granite, black appliances, nice lighting, door handles. It's little things, but things that make the difference to the tenant. Again, when you're walking to your unit, you don't want to see this thing on the left. You don't want to see dirt and mold and caulk and all that stuff. You want a nice, clean walkway to your apartment. So that's what we did. We listen to our tenants. So we want to do what they want because this is their home. So we found this property, there was lots of dogs. We added a dog park. Instead of doing just the ugly chain link, we went extra step, we added the nice wood. So it's just nicer for our tenants. Another big thing we focus on is security. You know, on the left here, we have all this really tall landscaping, which leaves lots of really dark spots. It doesn't make you feel very secure when you're walking through these breezeways. So what we did is we knocked that down. We put in some sod and some nice updated landscaping to make it feel more secure, put lighting everywhere. So, you know, nobody can hide behind anything. It's very, very updated and clean and safe. Again, we are just taking the old, we're not necessarily replacing it, we're just making it better. So we took this old arbor, it was a little tired, we did some repairs, painted it nice. The pool deck was pretty blinding, it was bright white, so we painted a nice sand color, and then we added a very nice built-in gas grill. So you can hang out around the pool, new pool deck, new grill, it's looking really, really good. Again, AC enclosures, gutters, shutters, parking lot respray, power washing the sidewalks. It's just little things, but it makes all the difference to the tenants. This was a pretty big project that we're proud of. On the left here is this old, nasty basketball court. Nobody touched it. Nobody wanted to touch it. The tenants didn't use it. It was just an eyesore. So what we did is we actually tore up the whole thing. We turned it into gravel, and then we replaced that old basketball court with a dog park. And now it's used way more, and tenants are actually able to use the property that they live at. Same thing here. It was originally a filled-in pool before our ownership, and you could do nothing with this place. It's just terrible. So what we did is we tore out all that concrete, and then we made it into a nice green space. And we just put that sod in. This is a property that we bought not that long ago. So that sod that's a picture we was just in. It's looking much better now. This was this old yellow unit. This color was pretty sweet, but you know, the tenants don't like it. So we put it nice, fresh white, again, wide plank LVP flooring, butcher block tops, new appliances, new cabinets, just make it nicer to be in. All right, so let's talk about the capital stack. So with a typical multifamily transaction, syndicator like us will say, you know, we need $5 million from investors or whatever it may be. That includes everything on the left there. You have your down payment for the loan, you have your CapEx money, loan fees, earnest money down, title, acquisition fee, PPM, legal, third-party appraisal. The list goes on and on. There's a lot of costs that go into these multifamily properties. It's not just buying them. You know, you have to do a lot of stuff on top of that. So even though all these things are totally necessary, they don't necessarily add direct equity to a deal upon closing. So all this stuff could and often does add up to hundreds of thousands of dollars by the time closing rolls around. And technically, you're negative equity day one. Now, it is an investment, and you got to invest money to make money, but that's a risk that we have decided to strip away from the investor base. So what we've done is we've separated that capital stack into the two most secured things we can, and then the least secure things we can. So what we require now for our investor base is the down payment. That's the 25 or 35, whatever it is, percent down on the property, and then the actual cash for the renovations. That's it. Greenstone is responsible for the loan fees, E&D, the title, all the legal work, the PPM, all the third-party stuff, the loan fees, the rate caps that we've had to get lately, the appraisal, all the reserves, and all the other costs associated with due diligence and travel times and inspection. So what that offers the investor base is the most secured part of an already pretty secure asset. And that's a way that we're just trying to put our investors first and, you know, take on more risk ourselves and offer the most secured part of that capital stack. So with that, I'm gonna turn it over to Kim, and she's gonna talk about her experience in asset management, how detailed this gets, and some of the common mistakes that she sees and she has saw in asset management.
Thanks, Isaac. So asset management is something I am very, very passionate about. I spend a lot of time nowadays speaking and helping to educate others on asset management and understanding the importance of asset management within the general partner role. I also work with a lot of investors on understanding what they should be expecting from the asset management role within their general partner group. And, just because in my experience in receivership, I really saw the unfortunate side of a lot of investors not being communicated to. And I consider myself to be a very empathetic person, and I just truly felt the need for these investors to be told the truth, and was compassionate to wanting, to seeing when their investments were failing and these general partner groups were not communicating. So I think that, my focus within Greenstone is asset management. And for those of you that don't understand what asset management is, the technical term for it is the asset manager's focus is to truly manage the risk of the asset, its partnerships, and its investors, while optimizing the asset's performance. This is done by consistently analyzing data trends for the asset, the market, and consistently reviewing ways to increase income, reduce expenses, without diminishing the quality of the people or the product. And that was something that was very hard to do as a third-party operator, and it really gave me a passion of understanding what the asset manager's role, sometimes that was very non-existent within a general partner group, and giving plans and expectations over to the third-party management company, which is, as I mentioned, where I began my career, and expecting your operator to succeed with unrealistic goals and not having the right tools to succeed. And that is really in the investment model, to be able to support the operational plan, or as Isaac just talked about, the construction plan. I think as Isaac also shared, we have created within Greenstone what we call our unique to Greenstone, reporting and processes, and this was created by our diverse team and really our diverse experiences. We all come from a different angle of real estate, as we've mentioned, through investments, operations, construction management, and all uniquely also working together on a lot of receivership opportunities that we worked for these lenders and servicers, and coming in on the broken side of these underperforming assets, really gave us that front row seat at seeing a lot of other investment groups, sharing in their successes, but unfortunately having to audit and see, their failures. And what I think I can, say that I gained from that experience is that most people think that asset management is engaged after a deal is identified or purchased, and they'll say it's the person or role to manage the manager, which is in theory the third-party management group. At Greenstone, we truly believe that asset management plays a significant role from the pre-acquisition process that Isaac just shared with you. That's in working with our team to choose our markets. We all, our whole team, our partners, as well as our corporate team and other employees, participate in the due diligence. We all work together with our acquisitions team. As I mentioned, Eddie and Isaac really, play the most significant role in, kind of bringing all of that to plan. But I think we all bring a different light and share a different light in that process as well, to create a solid pro forma. And as I mentioned, doing that due diligence that helps to create the story, and then really detailing that story in our operational plans and our CapEx plans, and really making sure that there's harmony between the CapEx plan and the operational plan to really work uniquely together. Our asset management, how I often describe it as well, is it bridges the gap between the investment model and the operational team. And I can't stress enough how important it is to have, if you guys are investing in real estate today, ask that question: who is managing those assets? Not the third-party management company, but who within the general partner group is optimizing that investment, who is reviewing things in the areas of people and in product to make sure that they're matching the culture and the investment model, and knowing when to pivot, and who's communicating to you guys. And I think that the third-party management company, or in our case, if we're personally managing it or using that, their role is the day-to-day operations, but you have to have somebody, and again, I cannot stress this enough, who is experienced. Ask them the experience within that team. Are they just in this acquisition buy mode right now? And so this group that you might be using your IRA money to invest with, are they experienced in multiple market cycles, like I mentioned? Do they know how to pivot or kind of change course that's going to be able to mitigate risks? When they're creating plans, we look at, in every decision that we make in our plans, risk and liability, things that will make us in our investments lose money, preventative maintenance, things that will help us save money, improvement, that's product improvement, things that will help us make money, and retention, and that's some things that will help us keep our money. And all 4 of those pillars are both in our people, in our product, and in our marketplace. We're consistently juggling all of those balls, looking at them all the time to see, is one area being influenced by the other? As we saw, recently with COVID, nobody could have underwrote or done their pro forma or even their due diligence to create a plan that would have supported COVID. But being able to see that coming and knowing how we might need to, pivot, where our residents live, where they work, what funds are available within the communities and the markets that we're in. Interest rates were another example of that. Making sure that your investment team knows that, are they purchasing assets? There's a lot of groups, that have underwrote for these bridge loans that are now turning into a permanent debt, that the interest rate, change in there doesn't support that investment model, and how are they adjusting during those times? So, truly having that experienced asset management team is critical. And like I said, it's something that, we at Greenstone feel that is one of the most important parts of doing that, alongside of, working with our construction management team. I consider them to be construction asset managers as well. As Isaac mentioned, every part of their plan is looking to optimize that investment. So, we're not looking to cost, plus profit on us. It's cost, plus to manage that, and to make sure that we are buying things in bulk and managing the quality and consistency throughout the investment process as well. So, in a nutshell, I really believe that I really want to stress to each one of you, understanding that pre-acquisition, through operations, through disposition team. And, that is something that we at Greenstone have really spent a lot of time being very intentional about building that infrastructure to be able to support that. And Isaac will flip to the next slide here. And that's just, I just want to highlight in closing for me, some of the things that I saw that were areas that were common mistakes that owners, and other groups have made in my experience, and kind of just encompassing everything that we sort of just went over. And, one of the things, like I mentioned, that I coach other people on is, seeing that these other groups have poor partnerships. How long have they worked together? Do they know how to, disagree, and how to still make strong decisions for the investment? Unsupported underwriting, as Isaac mentioned, that, are they just using, this quick plan on the numbers, and, but not really understanding how they're creating those operational CapEx plans. Ask them to see those plans. I think that is very important. looking at these groups and not having clear vision, not understanding what that exit strategy looks like. They're banking on appreciation. They're not beginning with that end in mind in every decision. A common statement that I use is, when your vision is clear, your options are fewer and your decisions become easier. Having that clear vision is very instrumental in real estate investing. Again, as I talked about, no asset management or input or oversight. Maybe they're coming in after the asset is purchased. Maybe they're just, turning it over to the operational team, making sure that that is truly being managed throughout the investment cycle. Inability to see the investment model clearly, resulting in failure to adjust the model or pivot when necessary. I just went over that, and as I mentioned, I don't think I could have created, any PowerPoint presentation that would have presented to an investor 5 years ago that would have included COVID, interest rates and inflation. I have been involved in other market cycles, so I have seen, where some of those areas are forthcoming and knowing how to pivot and adjust. So that is something that, we do account for in our CapEx plans, in our construction prices, as we've seen, the changes there, as well as in our investment structures. And then, final for me in closing is, really one of the things that we at Greenstone in our culture believe is just an honest, transparent communication. As I mentioned, one of the things that I just really broke my heart was to have to represent a general partner group that, I didn't believe in as an operator, that wasn't managing the investment structure the way that it should be, wasn't communicating. They were just clicking and sending, this 129-page book of financials, but really creating the investor experience for their partners and allowing them to see the investments successes, and some want to look at it very forensically, some want to be a passive investor, and they don't want to look at all of those areas. And for them, I encourage having an asset manager that's going to manage their portfolio for them. But the key is to really making sure that your general partner group has that, and they are creating that experience that's in the reporting and in the communication to each one of you as well. So I thank you guys for having us today, and if there's any questions, I think Reneika is going to provide our information out to each one of you. Here's a snapshot. You can QR code a direct link to contact both Isaac and myself. There's also a QR code to schedule a call. We're happy to jump on a call with you guys as well. We're happy to schedule a meeting with Reneika as well to go over your IRAs, see how there's opportunity to invest, in real estate. And, she definitely is, that is her lane and her skill. So, but if there's anything that we can support, in answering any questions in regards to real estate, multifamily investing, we're happy to meet with you guys as well. So thank you, and don't forget to be the light.
Thank you, Kim. Yeah, there's lots of questions that's in the chat box, but I'll let Isaac, if you have any additional information you want to present or any comments before I go to the questions.
Yeah, thank you, Kim. I mean, that's so vitally important. Make sure everybody works together, make sure everything is transparent, make sure you know who you're doing business with at the end of the day. So there's a lot of good groups out there, there's a lot of bad groups out there, but what makes Greenstone special, we're vertically integrated. We have a wide variety of talents in the same office. We have a very good investor platform, our exclusive underwriting software. We have experience in just about every market cycle, region, asset class, whatever. We've been through a lot, so we know a lot. We have a uniquely sheltered capital structure that we talked about, separating that the down payment and the CapEx dollars away from the more risky but necessary costs. We have expert asset and construction management. We have the best protective LLC structure we can for multifamily investments. We're great with communication. We control our CapEx costs through buying alliances. That's what we talked about, controlling those costs, allowing us to spend more of that money actually on property. And our nationwide network of brokers, vendors, and service providers allows us to get the most competitive pricing for each sector that we want to spend money on. So, like Kim said, these are QR codes. The bottom one's Kim, the top one's Kim's, bottom one's mine. Those are both our contact information. Feel free to reach out to me. I can talk about this stuff all day long. So that's my cell phone number and my email right there. And then schedule a call with Kim if you'd like to meet with her more in depth about asset management, multifamily, or some of her experience. She is an absolute wealth of knowledge. So feel free to reach out to us both.
Thanks, guys.
Thank you both. I do have questions we can kind of go through. So I'll just go through the questions, and either or can take the question. So the first one is, will you have access to the slide? Yes, we will provide you copies of the presentation. So the first question is, the example of forced appreciation is great. Rents are projected to decrease over 2023 to 2024, and cap rates are compressing. How will you address this near term?
So that's a fantastic question. So I'm going to go back to this slide really quick, talk about right here. So one of the cool things that we can do through forced appreciation, and I kept it just the same cap rate to keep it simple, rents will go down compared to what they have been. We have been increasing rents at a crazy yearly rate. So that rate is just going to go down back to not astronomical what they have been, normal levels. So the rental increases will drop, but they're going to drop to normal growth levels. So we're going to adjust our underwriting correctly. You can't. The past couple of years, it's been a crazy market, and people have been able to achieve unheard of things just because of the natural market cycle. We're transitioning more into an organic market cycle where normal rent bumps are going to come back, and you can't get these crazy value increases that you can just because of the market. So we're going to do the work that we talked about to increase that NOI that will help us even if the market cycle isn't as good. So even if we exit at a worse cap rate, let's say we exit at a 6 cap, $216,000 at a 6.5 cap, that's still worth just over $3.3 million. So even if the cap rates are increasing and uncompressing back to a normal rate, if we do our job right, then we will achieve profit on that investment.
Thank you, Isaac. Next question is this a fund structure, or are these one-off investments?
No, so they're not fund structures. Right now we're doing 506 Bs and Cs. We've considered a fund, but what we've done in the past is the 506 Bs and Cs. So okay, each individual is its own separate investment.
Okay, and a follow-up question to that is, do investors have to be accredited?
If we do a 506C, yes. If we do a B, no. So it just depends on the offering. Like I said, it's on a per deal basis.
Okay, next question is, how many projects do you have in process at one time?
I mean, to tell you the truth, it really varies. So, I mean, there's busy times of the year, there's not busy times of the year. We had the capability to have quite a bit, project-wise going on at the same time. Now, I will say, having, buying 3 projects at the same time, that's a lot of work. An average closing is 60 to 90 days, and there's a lot that goes into that. So, we have the capability to actively close on multiple projects at once while maintaining and operating our portfolio. That's not an issue. But as far as numbers wise, it really just varies. But we have the capability to do multiple projects at once while also maintaining successfully our existing portfolio.
Okay, next question is, just bear with me. What is your talented retention and collection ratio?
What could you repeat that again, Reneika?
The question is, what is your tenant, I'm sorry, my apologies. What is your tenant retention and collection ratio? Tenant ratio, retention and collection ratio.
So it really just depends on the investment model. Sometimes we're buying a full reposition asset where we are kind of like where there's forced appreciation, we're forcing the vacancy to be able to, get rid of the underperforming parts of the investment, which are the residents that are slow payers or no payers. That is done through a strategic lease-up plan. While we're working on the capital improvements, we are also working on the renewals and the non-renewals of those residents. So sometimes that can increase, but once the asset is stabilized, we pretty much work on a 3% vacancy and delinquency on the assets. Like I said, we really look at that every month to make sure who we are renewing and why can they afford our rental increases based upon that plan. That's where it really goes back to that original plan set up to make sure that that can support. But when the asset is underwritten, we do project and pretty much sustain and support that lower vacancy and collections on our assets.
Okay, next question is, what is the typical age of properties you purchase for upgrade?
So the typical age is, I would call it 1970 to 1980. Like I said, 46% were built before 1980, and that happens to be the class where our skills are most effective and profitable. We could buy these newer assets that don't need a lot of work, but we're experts at getting these old properties and making them really, really nice and spending money on them. So I would say mid 70s to early 80s. That's the age where structurally they're super, super sound, but they're often just in need of some capital. So, but we consider everything from, let's say, 1970 to 1990.
Okay, next question is the 16% annual rate of return guaranteed? I think you mentioned 16% over the 20-year period, but they're specifically asking, is the 16% annual rate of return guaranteed?
Yeah, short answer, no. So nothing is guaranteed. It is a pref. So essentially it's a 6 pref with a 10 back end. So all in all, investment to exit over 5 years or however many years it is, you'll get a 16% return. 6 of it will be a pref, the 10 will be a back end. But no, nothing is guaranteed. It's all a pref. We, like I said, we structure our deals to be like the most safest and most sheltered capital stack we can, and it is a preferred return. So our investors get paid before we touch a dime. But no, nothing is guaranteed.
Okay. Next question is, how does good property availability today compare to the past 5 years?
What was that?
How does good property availability today compare with the past 5 years?
Property availability, as in like what's available on the market.
Mm-hmm.
It's slowed down in the past couple months. So like I said, there's been like a buying and selling frenzy just because cap rates have been so compressed that everybody is trying to get a piece of that. And we're going to a more realistic cycle now, to where sellers are having to face the realization that if they sold their property a year ago, they would have got more money. So it's slowed down a little bit, but the deals we are seeing are more true. So a year ago we would see a property, I would do some rough numbers on it, and I would determine that the valuation, there is no way that we could pay for what they're offering. But ultimately somebody would end up paying for it, and that might be a bad investment for them. And hopefully it worked out the best, but there was a lot of deals that were overvalued in the market. So even though the volume has slowed down a little bit, the quality is definitely much better and more realistic.
Okay, so let me just make a comment relating to self-directed, and then of course I do have 1 or 2 more questions. So if you're using your self-directed IRA to invest in real estate, whether it's multifamily You could be subject to what's called UDFI tax or UBIT tax. For you to ask the question, you can definitely reach out to me and we can do a deeper dive. But the question specifically for Greenstone is, given Greenstone's 15 plus years in the multifamily industry, what is the breadth of your current portfolio, i.e. meaning doors, asset under management, and of course, which metro areas?
What was the last
go
part there? What was the last part?
So they want to know what is your current portfolio, the breadth of your current portfolio, meaning how many doors, assets under management, and the metro areas. I know you referenced you guys focus on the Southeast, so they want to know like the metro areas specifically, how many doors you have or assets under management.
So as far as I'll let Kim talk about the previous experience. We sold off all the rest of our nationwide assets in 2021, and we just have refocused on the Southeast. We found it made more sense logistically. You know, we operate successfully in Texas and Arizona and you know, Ohio, all over the country, but it makes more sense since we're such a heavy value add company that we want to stick closer to here and be able to ship materials and control vendors and prices better. So currently we have just over 300 units. That is by no means indicative of our experience. Markets wise, obviously we like the north side of Atlanta. Auburn is a fantastic little small market that doesn't get a lot of attention. Markets like Tennessee, a little bit east of, not Tennessee, but Chattanooga, a little bit east of Chattanooga. We like Knoxville, the northeast and not the northeast, the northwest side of Knoxville. South side of Nashville is good. We like the Kingsport, Johnson City area. We like a little bit south of Birmingham along 65 there. And then Northern Georgia. Northern Georgia's been amazing. And then we're looking to expand a little bit into possibly Mobile. There's actually some really, really good market metrics right now in Mobile. But right now, those are the markets we're focusing on. So, and I'll let Kim talk about some of our past multifamily experience.
So yeah, so we've managed over 25,000 units, and as Isaac mentioned, you know, we do through construction and asset management, we still do have you know, a higher portfolio of that. But as far as Greenstone, our acquisition side, you know, we have been in a lot of partnerships and purchased assets, you know, and really just started our focus on truly being that vertically integrated company and allowing our focus and our talents to be used on our own assets and our investment opportunities to be focused around those in the markets that Isaac just mentioned. So, you know, we have sold off a lot of our portfolio with the anticipation of being able to go in through acquisition mode with a more focused area. This coming market, you know, where we are in the recession, the market, there's going to be a lot of opportunity. We are, as Isaac mentioned, looking to create a fund as well as a lot of other diverse investment opportunity structures. So we really wanted to open our investor platform and our opportunities to be able to plan for that growth and kind of moving away from a lot of third-party work that we were focused on to really work on our acquisitions.
So I want to add really quick to what Kim said as far as deals coming down the pipeline. This year, there's $55 billion in bridge loans coming due. So we talked about how hot the market was and how easy it was to buy because valuations were astronomical. A good amount of those bridge loans were underwritten incorrectly. I mean, there's a lot of projections as to what percent of those, but there will definitely be some deals being forced to market because those bridge loans are expiring and they're going to have to qualify for permanent debt or a bridge that they can't afford. And so they're just going to have to put them to market and hope they can get out what they put into it. So we've aligned ourselves with brokers in those markets that I discussed to try and capture some of those loans that for inexperienced operators, bad asset management, whatever the reason may be. It's been a little bit too easy to buy, and now they're going to have to go to permanent debt. So we've positioned ourselves to capture what we can of that $55 billion in bridge loans coming due.
Thank you, Isaac. Thank you, Kim. We ran just a little bit over, but great questions. If there's any additional questions, definitely feel free to reach out to me. Also, too, you will receive a copy of the slides. And with that, I want to let you know if you have specific questions, so you want to know more about self-direction, definitely feel free to visit us at advantaira.com. If you want to know more about Greenstone Multifamily, feel free to reach out directly to Kim or Isaac. And again, I just want to thank you both for knowledge sharing with us today.
Awesome. Thank you so much, Reneika.
You're certainly welcome.
You have a blessed day.
Likewise.